Now, the next stage of a policy is the actual approval. Every lending institution, depending on the life stage it is in, will have a policy which will say who can approve what amount of loan. Does it come to a regional officer? Does it come to a zonal officer? Does it come to the head of credit at the head office? Depends on the size. A small new organization, files might be more centralized in decisioning. But as an organization grows and it has multiple branches and larger number of business, the decentralization process kicks in. What happens in the decentralization process is that depending upon the training and the ability and the experience of the individuals at the regional, zonal and branch level, certain loan amount levels are approved by the particular regional, zonal or credit officer at a branch. And only deviations or large tickets will come into the head office or to a senior level. This deviation policy again is a policy, but it varies. It varies from organization to organization, depending on its size, depending on its age, how young or old the organization is, depending on its geographical spread, depending on the portfolio behavior of the past cases that have been done from a particular location. All this has to be defined in the policy. So when you're defining a credit policy, please understand, ultimately you have to take all the elements of the process from the time you get a loan application till the time you return the documents and define what is to be done, not how. The how is a process. What needs to be done, what deviations you can have, what are the regulatory requirements, that is credit policy. Now, having sanctioned the loan, there is a sanction letter or an offer letter that goes out. The contents of that sanction letter is also a policy. You want to put in certain conditions, like for example, you insist on, say, life insurance for the main borrower. You might insist on general insurance from the property that is being financed. It might be a regulatory requirement. You might require him to pay certain fees. There are certain documents that will be submitted before disbursement. All that has to be spelt out in the policy. Now, this looks like as if it's a very straitjacketing or a handcuffing document. It's not. It actually facilitates sanity and standardization within the organization. It helps an individual appraiser who's doing a loan sitting in, say, a distant location from the head office to be able to follow what is the discipline, what is the structure of deciding whether to give credit or not. Because remember, this is a credit policy. Now, once the loan has been sanctioned and the offer letter has been given, the sanction letter has been given, the customer has to submit certain documents. Now, what are these documents? These are documents pertaining to the property. Now, again, that's a policy. But it is overlaid with the fact that if you're buying from a developer in a particular state and under construction property, the documents required are fairly standard in that situation and in any other situation. You're constructing, you're buying in a resale, you're buying from a developer, and all these documents that you require will be specific to each state, and that has to be in the policy. And this is not something that a lending institution can choose whether to put it in or not. It is something that the state government or the central government or the local authorities require and therefore definitely need to be in that policy. After the person has given all the documents, then there has to be a policy on disbursement. Is there a technical visit required? Is somebody required to sign off on the disbursement? After disbursement or after sanction, the customer comes back asking for a higher loan. Or he says, I don't want the balance loan. What is it that you as a policy need to be looking at? Should you look at it? If so, under what circumstances? If the person has come after 6 months, should you do a reappraisal of the case? Should you pull a fresh credit bureau report? Should you look at his repayment of the last 6 months and see whether he's paid on time? There are many aspects, and you as a lender will, of course, go through those aspects, but more importantly, the credit policy will definitely need to spell this out. And then you as a credit officer have to implement that policy. Can you do a deviation? Of course you can, within the deviation matrix that has been laid out by the organization. Now, when the loan is repaid, you release the documents. That itself is a policy. How do you retrieve the documents? How do you sign off? How do you give it back? All that also requires a structure. The process is different. Here we are talking about policy, and I'm repeatedly emphasizing this because often people think that the process is the policy and the policy is the process, and there's a little bit of overlap in the minds of people. So for example, as a lender, you might know how to do something, but what it is that you have to do to enable you to do that how is the policy. So this is overall the credit policy, because you've now taken a decision based upon these parameters: regulatory, risk, customer profile, appetite of the organization, and you've sanctioned the loan, disbursed it. But before you do that, you need to make sure that you've applied all the legal policies and the technical policies on the property. So the next part of this module actually goes into that part. Remember, organization level requirements, all of them under this 6-letter word called policy. So here's probably the best example of a policy requirement at the credit stage. We talked about the loan to value ratio from a regulatory perspective, but ultimately, once you have determined what is the income of the applicants, you need to now decide how to give the loan or how much to give of the loan. So what is the mathematics that applies to this, and what is the policy requirements as far as this is concerned? As you know, the two important components or two important formulas or two important ratios that are used by lending institutions to give a loan is the installment to income ratio and the fixed obligation to income ratio. To recap, and of course there is a full module on that, to recap, the installment income ratio is the ratio of the installment that you work out for the person, the customers, to repay the loan, divided by the income that you have appraised through the policy. Fixed obligation income ratio includes not only the installment of the loan that you are proposing to give, but also any other loan liabilities that the person may have. As I said, all this is explained in greater detail from a mathematical and conceptual point of view in our maths module. But the lending institution must have a policy that these two ratios, the installment income ratio and the fixed obligation ratio, cannot go beyond a point. For example, you cannot take an installment to income ratio of beyond 40%, maybe, because it is felt that after 40, the servicing capacity is jeopardized, which can actually impinge into the repayment of the individual and then cause delinquencies and defaults and provisioning and losses. So the lending institution will put down a number, an IRR not more than X%. That X can be 20, 30, 40, 50, whatever it might be. In fact, it can be different from different customers. So for the employed persons, it might be X. For self-employed, it might be Y. For a high net worth individual, it might be something else. And for a microfinance lender, it might be something else. Whatever it may be, it has been put there by the persons who wrote the credit policy based on some method, some logic. Most importantly, based on some data. Once these numbers are there, is it possible to go above? Of course it is, but with, again, logic. The deviation policy, which will be built into the credit policy, will specify very clearly whom you can go to in the organization, under what situation, and what amount of deviation. So from 40%, you might be able to go to, say, a 45 or 50, but going to 70 might challenge the deviation matrix itself, and you might not be able to give a loan, or you might not be able to justify that loan to the recommending authorities who will finally approve the loan. So this is an example, and probably the best example I can give you of what a policy should have.